For the first time in more than 2 years, the Central Bank of Nigeria has increased interest rates to 13%. That's from 11.5% previously maintained since 2020. While the hike by the Monetary Policy Committee was expected following the rise in inflation, which hit 16.8% in April. But the 150 basis points increase came as a surprise to not a few. Well, the committee says its decision to change course was driven by a number of factors. Well, Arise correspondent Onyi Sunday reports.
The central bank's decision to increase interest rates by 150 basis points follows rising inflation rates. The CBN expects higher inflation in the year owing to external and local factors, if not curtailed.
The major central banks such as the US Fed, the Bank of England, the European Central Banks, and the Bank of Canada have provided strong guidance of a progressive shift away from monetary policy accommodation to drive market interest rate upwards, which may ultimately impact capital flows away from emerging market economies. Domestic price development is, however, expected to maintain an upward pressure in the light of the build-up of increased spending related to the 2023 general elections.
At its last monetary policy meeting in March, the need to strengthen Nigeria's fragile economic recovery took precedence, even with a GDP growth of 3.98%. But with a GDP of 3.11% at the end of the first quarter in 2022, the rising cost of energy and electricity tariff did not sway the bank's decision to increase interest rates in a bid to rein inflation.
While it may seem contradictory to raise rates in the face of fragile growth, it is a dilemma that most central banks around the world today are grappling with at this time. Yet, on balance, it is quite clear and compelling that tackling inflation is more urgent in the sequence of policy objectives.
With interest rates at 13% from 11.5% in September 2020, lending rates are sure to spike, further compounding challenges businesses face to stay afloat. To tackle this, the CBN says priority sectors will continue to receive support through single-digit interest rates.
In this regard, MPC urged the bank to redouble its efforts at supporting the priority growth-enhancing sectors of the economy, while urging the federal government to do more to provide a safe and secure environment for economic agents to boost activities and eventually stimulate growth. The bank further reaffirmed its commitment to continue to provide support to priority sectors as the need arises to support growth until the current upward pressure in price development abates.
As Nigeria's election year gets into full swing, will a hike in interest rates curb skyrocketing inflation? Time will tell, but the recent move by the CBN is sure to get the attention of foreign portfolio investors and might help a fast depreciating naira. But it's an election year, and with it comes political risks. Onyi Sunday, Arise News.
Well, thank you for that report. And Economist Professor Ken Ife joins us now for more on this. Good evening. Thank you so much for joining us in the news tonight.
Thanks for joining us.
For having me.
Did that decision come to you as a tough one? Do you see the wisdom in it?
Well, it was expected because inflation, not inflation targeting for Nigeria, but generally is a global phenomenon right now because they are now incensed. Many countries are incensed by the surge in prices of petroleum products, of gas, of wheat, many, and it has a knock-on effect for many African countries where almost 80% of their manufacturing capacities are dependent on imported raw materials. So that's the transmission belt there. They need energy to process their materials, and then they will pass on all that inflation to us. So we have a degree of imported inflation, and then we have structural factors at play in Nigeria. So our own is a bit more complex, but there is a general trend of raising interest rates. I mean, America is on 8.5%, the highest in 42 years. UK is 7%. So they're all looking at inflation targeting for that purpose.
So what you're saying is that this move by the MPC was, I mean, more or less inevitable. I mean, since that's the global trend.
To some
but
degree.
If you look at Nigeria's peculiar situation, and like the CBN governor said, I mean, it looks contradictory that at a time like this, you're raising interest rates.
Yeah, well, that is it. On the face of it, it looks contradictory. But when you look at Nigerian circumstance more closely, on one hand, in fact, the governor played both sides. You could see more structural factors at play in Nigeria, driven by insecurity, and then you have cost-push inflation because costs are rising very fast. You've seen what's going on with fertilizer, wheat price more than 200-300% increase. You've seen all that playing on at the base. But there are other issues that there's speculation in our economy. And that speculation, don't forget that Forex is a pricing mechanism, it's pricing. Yeah. So that speculation is making people borrow naira, borrow from the bank to buy dollar, hoping that there will be, the naira will depreciate.
And this
just to make money.
In spite of the CBN's move in the past to check this speculation.
That's just to make money.
Has it failed?
No, that's a different ballgame. Look, they're also using the money that they borrow to import, and you've seen trillions of naira trade deficit between Nigeria and China. And then you have politicians on the fray that are now looking to dollarize the economy more, and then so there are more extraneous causes, and that required a sharper response. So that's why I wasn't surprised. I had expected 1%, 100 basis points, which is 1%.
Some
not
even 1.5,
because after all, the interest, the GDP was positive news, but also the inflation itself was just around 1% increase. I was expecting about 1%. Not that there's a linear relation between the two, but that was, a bit. But the reason why I had to, eschew my thoughts is that we need extreme measures because of what the political climate is making people buy dollar. And then also the speculation is very. I'm not worried about the foreign exchange situation because 93% of the Forex is going on in the NAFEX window, even though there's a little shift.
Let me ask you.
But the bulk is there in the window.
Okay, I don't have to be an economic expert to know that there's going to be a knock-on effect on businesses and households, right? Especially for families that
on the economy as a whole.
No, I've got to deal with that. I've got to deal with that.
Okay, wait. Let me put my point out, because families are overstretched, households are overstretched with prices of food, electricity, fuel, gas in general. So how do we cushion? What are the knock-on effects we're likely to see, and how do we cushion this? I mean, he talked about priority areas still receiving in single digits, but how do we cushion the effects generally?
No, the thing is this would actually help bring down inflation.
Okay.
Because there's an excess money supply in the system. We have been hoping that we will use other instruments at the disposal of the fiscal authorities. They are borrowing more domestic.
Are you saying there will be no knock-on effect?
No. I'm not saying that there wouldn't, but it's not going to be as you expect, because this measure will actually help curb inflation, which means the household will not feel a pressure for higher inflation. And the thing here is the real selling point for me is that we have about 3 trillion naira out on intervention funds to the real sector. 1 trillion for Anchor Borrowers Program, and then you have 2 trillion out there and there are single-digit rates. Remember, they're still around 5% up till March next year. So that's why I'm more comfortable, because I know that the sector that is producing and giving us the food and giving us are actually insulated by the domestic finance.
Great. When you say the inflation rates will fall, is it in the short term, in the medium term, or in the long term? How quickly do we expect these measures to begin to take effect?
It's difficult to do that. I tell you why. Because there are issues about transmission of monetary policy. About 40% are not even in the banking sector. And then you have young people are being taken away by cryptocurrency and all that stuff going on. So, it doesn't always work one-to-one in the relationship. So, it takes time. And even when people are borrowing, or they're not even borrowing the money to put it in productive activity. Some are borrowing it for other purposes, to import goods or to, so that's why it's difficult. You don't have a one-to-one relationship.
But are you saying that
there would be an effect, a positive effect on inflation.
Okay.
But these figures, are they realistic? 13% MPR, asymmetric corridor, you know, plus 100 minus 700, CRR 27.5%.
In the
liquidity
context,
ratio.
in the context of the political arrangement now, that is the electioneering, the pressures require extraordinary measures. So that's why I support that, because we are so, you know, you've seen what is going on in the black market right now.
Yeah.
It is jumping through the roof. But at the same time, you've got the politicians now needing the money to do what they need to do. So they will be borrowing this money. And those who borrow will borrow at a higher cost. So you'll be discouraging that. But those who are also borrowing to go and import reckless thought that they are importing, and as you know, trillions in the deficit, in trade deficit, they will be discouraged because they have a higher interest to contend with. So those are the areas where they help to tame inflation.
All right, we hope sooner than later. Thank you so much, Professor Ken Ife,
Thank you.
for joining us and, you know, breaking this down for us.